Good morning, everyone. This is Marshall Gidler bringing you the morning comment for February 11th. Well, Greece and Germany seem headed for a collision course today as both sides have dug in their positions ahead of a meeting of the Eurozone finance ministers today. Greek Prime Minister Tsipras said he wants a new agreement with official creditors, but German Finance Minister Schäuble said there are no plans to discuss a new accord or to give the country more time. Now, Eurodollar has been surprisingly stable recently, but this could be coming to an end as we come down to the wire in the negotiations. The economics of the situation are quite clear. Greece can't pay its debts and needs to have them reduced. However, the Eurozone has always been a political project, not an economic one, and German politics rule against any debt write-down. Thus, we're indeed headed for a collision course. Now, I'm an optimistic guy. I still believe that a compromise will be reached, but as usual for the Eurozone, it will only be reached at the last minute and only under pressure from the markets. That pressure is likely to appear in the FX market as a weaker euro, in my view. I have to add, though, that this isn't the unanimous opinion of the research team here. Others feel that Greece is in such bad shape already that the government may feel it has nothing to lose by leaving the Eurozone. Indeed, one possible explanation for the recent stability of Eurodollar is that some investors may think that a Grexit would be beneficial for the euro, as the group would get rid of its weakest member. That may be so in the long run, but in the short run, the market would price in the uncertainty of other countries leaving if Greece left, meaning a weaker euro, in my view. Now, two Fed officials made very hawkish statements yesterday, which may have contributed to the dollar's general rise. First, Richmond Fed President Lacker said the recent U.S. data have, quote, solidified, unquote, his view that the Fed should raise rates in June. San Francisco Fed President Williams said that economic conditions are getting closer and closer to those where it makes sense to start thinking seriously about starting this process of normalization. Fed funds rate expectations continue to rise, again, the opposite of what's happening in most other countries. So, as I've said many times before, this monetary policy divergence should continue to support a stronger dollar. Oil plunged on comments yesterday from the International Energy Agency that excess supply will persist to the middle of this year. The fall dragged down the commodity currencies with it. The Canadian dollar was the worst performing G10 currency, as Bank of Canada Governor Poloz argued that the Canadian dollar was falling not because he's talking down the currency, but because the economy is deteriorating. So watch the CAD. As for today, the market will be waiting to see what comes out of the Eurozone finance ministers' meeting. I expect that they'll repeat their unwillingness to compromise, and this may finally kick Eurodollar out of its range. Otherwise, no major indicators are on the schedule. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Marshall Gidler, head of Global FX Strategy at IronFX Global, wishing you solid trading.